p.m. only on Bloomberg Quint.
Thanks for joining us on lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Indian markets gained some momentum driven by a rally in select metal stocks. Nifty Bank surges ahead of the weekly options expiry.
Tech Mahindra will spend up to nearly 2,000 crores in its first ever share buyback at 950 rupees per share. The offer stands at over 15% premium to the current market price.
The government will infuse about 48,000 crore into 12 state-owned banks to ensure they remain well capitalized. This will help Allahabad Bank and Corporation Bank come out of the prompt corrective action framework.
Reliance Capital offers to sell its stake in the asset management company to partner Nippon Life.
And the Kalyani Group is hoping to foray into jet turbo engine and drone manufacturing, says Chairman Baba Kalyani in an interview to Bloomberg Quint.
We'll get to all of that. Quick check on how the markets are faring. There's some momentum in metal stocks today. Yatin is here with a closer look of what's going on. Yatin.
Good afternoon, Harsha. And the momentum in the metal stocks does continue. But if you look at the top gainers on the Nifty at this point in time, it's Indiabulls Housing Finance, Tata Motors, Grasim, as well as Vedanta. All of these stocks gaining anywhere between 2.5% to 3%. Not only that, we have the big boys, Reliance Industries and TCS, which are almost 1% higher. And these are the two heavyweights which are pushing the index higher at this point in time, which is leading to an advance decline ratio of 3:2 on the Nifty at this point in time. On the flip side, we have the Bharti Group stocks, Infratel as well as Airtel. Both of these stocks are down. Infratel being the top losers, 3% down for that one. The stock has been quite volatile. Not only that, we have Yes Bank as well as Eicher Motors, declining marginally in trade. What needs to be in focus is Reliance Capital as well as Reliance Nippon Asset Management Company. Both of these stocks are quite active in trade, 10% up for both of these names after Reliance Capital announced its intention to pare down its stake and sell it to their existing partner Nippon Life. And if you look at the entire 42.88% stake held by Reliance Capital, if the entire sale were to be done to Nippon, that would fetch the company close to 4,000 crores according to the current market valuation. Probably on the back of that news announcement on the stock exchanges, both of these stocks are active.
Yatin, thanks so much for that. The government will infuse a little more than 48,000 crore in 12 public sector banks, most of which are under the prompt corrective action framework. This takes the total bank recapitalization amount to over 1 lakh crore in this financial year. Nikunj Johri gives us the details.
The government announced capital infusion of little over 48,200 crore rupees in 12 public sector banks, taking the total amount of capital infused in public sector banks to over 1 lakh crore rupees in the current financial year. The two banks that get the most capital in this tranche of capital infusion are Allahabad Bank and Corporation Bank, who have received 6,900 crore rupees and 9,100 crore rupees respectively, helping them in coming out of the RBI's PCA prompt corrective action framework. The four broad objectives of this capital infusion are firstly the one that helps these two better performing public sector banks, that is Allahabad Bank and Corporation Bank, to come out of the RBI's PCA framework. The second objective is to enable the public sector banks that have recently exited RBI's PCA framework, which are Bank of Maharashtra, Bank of India and Oriental Bank of Commerce, to comply with minimum capital requirements. The third objective of the capital infusion is that this will equip public sector banks that currently do not come under the RBI's PCA framework but are on the verge of coming under RBI's PCA framework to come out of it or stay out of it. The fourth and the last principle or the objective of the capital infusion is that this will enable public sector banks which are under RBI's PCA framework to maintain minimum capital requirements.
Nikunj, thank you for that. Let's move on. Aditya Achrekar, Associate Director at Care Ratings, now joins us on the show. Aditya, thank you so much for joining in. Firstly, we didn't hear the word capitalization in the budget this time. So where is the money going to come from to fund these banks?
See, the budget for FY20 did not speak any recapitalization, but it was from the FY19 budget. So some out of that 1 lakh crore infusion was there in the last budget for FY19. So we are expecting that money should come within, by the end of FY19.
Aditya, can you give us a sense of the breakup and which banks will benefit most?
See, if you look at, there were total 11 banks which were under PCA, out of which 3 banks have now come out in the last month. And then one IDBI was there, which is now been taken over. Majority stake has been taken over by LIC. So, and the remaining 2 banks are there. So Allahabad Bank and Corporation Bank, as you said earlier, will be the most benefited by this capital infusion.
Does this infusion to these banks mean that their capital requirements are enough, or would this require further infusion as well?
I mean, see, if you look at most of these banks, so these banks have been conserving capital. So they were targeting their risk-weighted assets, and because these capital ratios are as a ratio to the risk-weighted assets, so they were kind of lending to some highly rated or high-rated corporates. They were not taking exposure in certain sectors. So definitely that, I mean, as in when the credit growth picks up, I mean, that is a call that each bank will have to take as they go on. But definitely this is a positive move for the public sector banks. I think now there will be a couple of 2-3 banks which would remain where the performance is not up to the mark. But then with this capital infusion, I mean, things look positive for them.
All right, Aditya, thanks so much for that quick call. Appreciate you taking the time to speak to us. Bank recapitalization there. Let's move on. 2 recent standstill agreements between mutual funds and promoter entities of Subhash Chandra Group and the Anil Ambani Group have raised questions about such funding structures. A deep dive by Bloomberg Quint shows that about 40,000 crore in equity-backed bonds issued by Indian promoters are outstanding in the market. 95% of these bonds are rated by 2 rating agencies who appear to have missed the risk in such structures. Advait joins us with details of what he found when he went digging behind this trend. Advait.
So, as you said, there are 2 companies in question today. One is Anil Ambani's Reliance ADAG Group and Subhash Chandra's SL Group. Essentially, these companies have structured their bonds so that they back them with pledged shares of the main promoting entity. The issue with these structures is that once the volatility of the share price falls, the security cover backing these bonds also falls. Therefore, when mutual funds buy these debt papers, the securitization or the security cover on those bonds, if it keeps depreciating, they face a loss on both sides, one on the default of the bond and one on securing the security. Our analysis for the 82 equity-backed bonds shows that the total outstanding is at 40,000 crores, which is only about 2 to 3% of the total pledged share debt market. These are only listed and rated bonds, where the rest of the market is mainly for unlisted and unrated bonds. We found that Brickwork Ratings and Infomerics have rated majority of these bonds at about 95.6%, while Care Ratings has rated about 2.5% and India Ratings at 1.8%. CRISIL and ICRA rating agencies haven't rated any of these outstanding debt instruments. We also found that majority of these bonds are in the A category, whether they are long-term bonds or short-term bonds, which makes the point that when these companies have been facing stress, why haven't the rating agencies moved the rating criteria down further as these risks kept building up?
So what's the risk in these structures, and did rating agencies and mutual funds look the other way?
It seems like they did look the other way, but the way the rating agencies essentially price the risk here is they look at the size of the security cover, they look at the promoting entity's overall credit rating, and they look at how many pledged shares the promoter already has within the market. Now, depending on these cushions and depending on the ranges and their formulas, each agency would use their own formulas, they price the risk. But the issue that clearly comes up is, as Amit Tandon has pointed out, is that the second the volatility of the stock, the variation over a year is more than 20%, as a standard security cover of 1.5 times the bond issuance or 2 times the bond issuance is not enough to cover the losses of any of the lenders or the investors who have bought these papers. Sources also told us that mutual funds have mainly bought these papers because they were earning about 50 to 60 basis points on these instruments compared to other debt papers. So it seems like the rating agencies were giving the mutual funds and lenders the ratings they wanted, and higher ratings depending on the depending on the promoting entity's brand and the larger group's rating. And because they were pushing these papers, they have seemed to have taking on losses whenever these debt instruments are defaulting or the redemptions are being delayed.
All right, Advait, thanks so much for that. And do go to bloombergquint.com to read more details on that story. Reliance Capital has offered to sell its stake in the asset management company to partner Nippon Life. Yatin is back with us with the details. Yatin.
Afternoon, Neera, and the exchange announcement by Reliance Capital indicates that Reliance Capital is willing to sell up to 42.88% stake in Reliance Nippon Asset Management Company to its partners Nippon Life. They have written to Nippon regarding this. Remember, both Reliance Capital as well as Nippon Life hold equal 42.88% stake each in Reliance asset management company. Now, if you look at RNM, the stocks are quite active, given the fact that probably MNC would acquire up to 42.88% stake, and not only that, Reliance Capital is also witnessing some short covering plus fresh buying, given the fact that they will be able to garner up to 4,000 crores via this stake sale, since the current market capitalization of Reliance Nippon Asset Management Company is close to 10,000 crores, and it will help them reduce their own debt. And if you look at the exchange filings, FY 2018 net debt to equity stood at 2.5% odd for Reliance Capital. So this move probably comes in as a deleveraging exercise for the ADAG group and Reliance Capital at large.
Nathan, thanks for that. Meanwhile, Reliance Communication has deposited 118 crore with the Supreme Court today. This after the Apex Court found the company and its promoter Anil Ambani in contempt. The court had also directed the telecom operator to deposit 450 crore within 4 weeks. RCom has also written to creditors seeking permission to access 260 crore, which it claims was refunded by the Income Tax Department.
Prime Minister Narendra Modi's fight against corruption may have had an unintended fallout. A survey conducted among 100 executives running mid to large size companies in India ranks regulatory compliance as the biggest cost overrun for these companies. Upamanyu Trivedi of Bloomberg News now joins us for more. Upamanyu, what is the message coming out of this survey?
Yes, this is an interesting survey that came out with these results, where almost 72% of these top executives of mid to large size companies thought that regulatory and compliance scrutiny could be the biggest cost overrun in the coming 2 years in India. Now, the reason they cite for it, and this is over other possible risks like political uncertainty, economic uncertainty, trade disputes and technological disruptions. Now, the reason Baker McKenzie cites for such an opinion is that there is a lot of focus on law enforcement coming out of countries like India, and they say that it is not enough for companies to just tick box compliances and regulatory issues. Now they have to spend real money to make sure that they are not just compliant, foreign companies are not just compliant in their home countries, but also in countries like India.
Upamanyu, thank you so much for that. Let's talk about Tech Mahindra now. That's announced its first ever share buyback. The company will spend up to 1,956 crore on the offer. Agam is standing by to take us through the details and the price that it's willing to pay over the current market price. Agam.
Right. Well, as you've already mentioned, Tech Mahindra has announced its first ever buyback. It is going to buy back as much as 2.1% of total equity, and the quantum by which the equity reduces by will also aid its earnings per share by just as much. That comes to as much as 2%, according to the EPS estimates of FY20. Now, at this point in time, we all know that Tech Mahindra has about 6,500 crores in its balance sheet, of which it will use around 1,950 odd crores for its buyback. It's carrying the buyback out at a significant premium to the current market price at around 950 rupees per share. And also, when it comes to shareholders' equity, it's approximately 10% of shareholders' equity, which means that it will not have to go ahead and seek shareholders' approval, considering it is within that bracket. That said, I spoke to the Chief Financial Officer of the company, Manoj Bhatt, and asked him about the future and whether or not the Tech Mahindra will continue to carry out buybacks and how they've arrived at the price of 950 rupees per share. This is what he had to say. Listen in.
the reason we chose a route which is the tender route and 10% is that we wanted to start off in a manner that it is equitable and proportionate. And if you look at, obviously, there are enough precedent examples of what buybacks are happening at what premiums and so on and so forth. And we wanted to make sure that it is rewarding for shareholders to participate in this buyback offer. I think those were some of the considerations. I think from a overall capital policy, I think we look at buybacks plus dividends as a combination of returning money to shareholders, and that's something which we will continue into the future. If I look at the last 2-3 years also, we have managed M&A as well as increasing payouts, drive on the back of improved performance in the business and improved conversion ratios. So to me, I think we will have to think of it as managing both, and that's something we will strive towards. And M&A will continue to be a core part of our strategy.
The Nifty 50 is up for a rejig as part of an exercise carried out every 6 months. So which stocks can make the cut and which will be on the way out? Devina Khanda standing by with possible candidates. Devina.
Well, Ira, like you rightly pointed out, every 6 months, so July 31st and January 31st of every year is when this rejig typically takes place, and that's the observation period, and that's when it's reconstituted. So the last review that happened, you had JSW Steel moving in, Lupin moving out, and we've already ended the January observation period, so most likely by the end of February you'll get to know the changes on the index, with stocks moving in and with stocks are moving out. So as per our calculations and as per the criteria set out by the NSE, two critical points to watch out for, obviously, for companies coming into the index. One, that their free float market capitalization has to be at least 1.5 times of the present smallest market cap company on the index. Second, the impact cost has to be just about 0.5 or lesser than that in the last 6 months period, the average impact cost, and 90% of the observations taking place. Now, what this means is there has to be enough liquidity in the counter that at any given point in time, if you have to actually go ahead and acquire a certain quantity, the impact cost should not exceed 0.5%. Now, based on these two criteria, what is the inclusions and exclusions? So HPCL now currently is the smallest market cap company on the index, so that most likely will be moving out. Replacing it will be Britannia or Godrej Consumer Products. Now, how do the market caps stand up, in terms of the overall numbers, and what has a better chance? So Britannia has a slightly more bigger market cap as compared to the Godrej Consumer Products. So Godrej Consumer Products about 29,828. This is the last 6 months average of the free float market capitalization. Britannia has 36,470 crores, and HPCL there, which is the smallest on the index, has 18,000. In terms of the impact cost analysis and what each of them stack up on the impact cost test, last 6 months average, the impact cost for HPCL has been 0.046%. Bettering that is Godrej Consumer Products, which is 0.45%. Still bettering that is Britannia, which is at 0.036%. So on both the counts, Britannia stands to be the winner in terms of the possible inclusion on the index. Now, how has this worked and how will it work for Britannia? So according to Motilal Oswal, the inflow will be about 480 odd crores because of the index funds have, the weightage changing and the index funds having to readjust and rebalance. Weightage will be about 80 basis points for Britannia if it comes in versus HPCL's 40 basis points, which it's currently standing at. In the past, how have things shaped up in terms of the pricing activity? So when JSW Steel came in 1 month prior to the announcement of the buyback, JSW Steel moved up 15%. From the announcement to the actual rebalancing, it moved up 9.5%. But that is not to say that it is the case for all the stocks that come into the index. In the past, you have seen moves divergent as well. Bajaj Finance, marginal improvement in the prices 1 month from the date of announcement, and in the period for rebalancing 4% higher. But Grasim and Titan did not have that great a luck. The other stocks that moved into the index, and that will come up on your screen, they too, like a Bajaj Finance, 12% higher 1 month prior to announcement, and a marginal move in between period. HPCL is the other one, and UPL. So this is to say that, you can't really predict whether the stock will actually move up ahead of the announcement, but this is the historical moves of the stocks that have actually done what they've done.
Lavina, thank you for that. That's an interesting Nifty rejig possibility on the anvil. Kalyani Group Chairman Baba Kalyani now wants to build jet engines and drones for the Indian Armed Forces. The Pune-based company builds artillery guns for the Indian Army, and Kalyani believes that the group's expertise in metallurgy will help. Sajid met up with Mr. Kalyani and asked him what's changed over the years for private players in defense in India.
It's very difficult before 2014, but post 2014, after Prime Minister Modi brought in his famous program on Make in India and increasing the manufacturing sector in India, I think we are now beginning to see a large change in the way this whole Make in India business in defense is beginning to operate. You know, the policy is in place. A lot of tweaking in that was required has happened. The communication channels between MOD, industry and services, all three together are quite open. Earlier that was not the case. And the most important thing is we are seeing tremendous collaborative process with DRDO that's going on, especially now. And I think, you know, if you put all this together, it's an unbeatable combination. DRDO on one side, who is developing technology and futuristic technology, industry on the other side, who can productionize these technologies, then MOD and the services providing test facilities to test, and DRDO also providing test facilities to test industry product. This never happened before 2014.
So what about the users? Because at one point in time, I remember you saying that the users preferred the overseas guns. Now are they looking at more of...
I never said that anybody prefers...
There were more preferences for...
No, I don't think so. I think the problem was nobody was making anything here. So where would the services get their products from? Somebody has to make it. Now people are beginning to make it. And, you know, as I said earlier to the other gentleman, anybody in the services would prefer to have an indigenous product because the life cycle cost of an indigenous product is substantially lower, lower by a few magnitudes compared to a product that you import from somewhere. Because you import from somewhere, after 15, 20 years, how do you get spare parts for that product? Because those guys have stopped making it. And the cost of getting parts for that is enormous. Whereas if you have produced it here, you can keep making parts for 50 years.
Coming to the Kalyani Group, sir, how do you see the order book for defense going forward for the next few years?
I think it will keep on gradually increasing. We have multiple product lines. That's the good thing about defense. We are very well diversified. You know, we have artillery on the army side. We are working on small arms. We are working on ammunition. We have these air bombs and things like that for air defense systems on the Air Force side. We are working on new products like jet engines. We have a whole series of components that we already currently supply to OEMs here as well as outside India. So, and now we are making a lot of new things, seekers, for example, small engines, UAVs. So all this has a future going forward.
Do you see big opportunity coming for UAVs and for seekers and jet engines in the next couple of years?
Yeah, I would say in the next 5 odd years, yes.
And how big will be that business? Because you're doing a lot of R&D in these three areas.
I mean, you know, there is no scale of business where technology is involved. If you look at UAVs, 15 years ago, nobody heard of UAVs. The UAV was a toy 15 years ago, okay? It was not something that you used in the armed forces or services, for example. So therefore, as technology gets more and more sophisticated, as technology gets more digital, as artificial intelligence comes into that technology, you will see many products changing their nature. Okay, so you will have a lot of products that will get obsolete, not required, and newer products coming in. So what are we doing? We are developing technologies. We are developing the building blocks of technologies. Now this building block is like a Meccano set or a Lego set. You know, you can put it together and make whatever you want. But if you don't have those building blocks, then you will never have the no why of anything.
Nobel Peace Prize winner Kailash Satyarthi says the amendments made to the child labour law plug a lot of loopholes. Speaking to Bloomberg News, Unni Krishnan, the child rights activist, says it now boils down to implementing the law. Listen in.
The government has passed a law banning child labour, but it's a watered down version of what first came out in 2012. Your thoughts?
Well, that bill which was passed had some positive element in it, but there were two serious lacunae. One was the definition and scope of family enterprises, and the second one was the hazardous occupations. They have reduced the number of hazardous occupations which were prohibited to employ children from 83 to only 3. And the scope of family was also very vague. So in India, you know, that uncles, brothers, sisters, but all kind of extended relations were considered a part of family. So I opposed it strongly. Many others are opposed, of course. And eventually, these issues are settled in the new rules of that law. So now we have very clear rules. So the number of hazardous occupations have grown from 3, which were in the bill, up to 103. So quite a remarkable achievement in a way. And similarly, in the family enterprises, the children would not be allowed to work in any hazardous occupations of any age. So that is also a significant move. So we have very, very good law now, along with the rules.
India now has a single-point emergency line of its own. Helpline number 112 was launched in 16 states and union territories this week. States like Madhya Pradesh, Uttarakhand and Kerala are some of the states that already are on the network, which will cover the whole country by 2020. Take a look. Out of time on the show. Thank you so much for joining us.
Lots more coming up.